If you're retired or close to it and you're working with a financial advisor, chances are with all of this volatility, you've been told to hang in there or just buy and hold. In this video, I'm going to explain why I believe that's a bad strategy and what the alternatives are for you. I'm Mike Lester, host of the Guarding Your Nest Egg show. I talk to people that are retired or close to it across the country every single week, and that's one of the top questions that we get. I'm not a big buy and hold fan. I'm not a big hang in there fan. It just depends on what's going on with markets. And one of the biggest things that really frustrates me with the financial services industry is so many people are being told as their portfolio loses 10, 20, sometimes 30, maybe even 40% as their portfolio is going down. Maybe the advisor they're working with isn't calling them. Maybe if they do call them, they're telling them to hang in there. Hang in there doesn't feel very good when you're losing money week after week or month after month. And I love educating people on the alternative to the hang in there strategy. You don't have to hang in there. You just need to work with a financial advisor or work with a firm that uses active management strategies. It's in our industry, it's considered tactical. Tactical could mean a lot of things. Sounds kind of aggressive, actually. But I think active management makes more sense to people. So we don't like buy and hold. I would love to buy and hold a position that continues to go up. I don't want to buy and hold a position that's all over the market. And I think as an investor, you need to understand the difference in the type of money you have. So if you have an IRA account, if you have a Roth IRA account, these funds can be actively managed, meaning, we can buy something, sell something, we can go from here, we can go to there. There's no tax consequence to the client. And if you're working with the right custodian, then there's no actual fee to make the trade. We've come so far from the old days of, the 1980s. You have a stockbroker, and then they give you advice, and then you buy something, and it's transactional. They make a commission. We roll into the 90s, and then suddenly the stockbrokers are now selling mutual funds, and they're getting what's called a load or a fee to do that. Our business or industry, financial services, has evolved. Unfortunately, too many advisors haven't evolved with it. We want to make sure that we're educating people on what's available, and active management of your portfolio is available. Nobody has to settle for buy and hold. So I'll give you an example. The other day, I sat down with Susan. Susan is 69 years old. She's single. She's got money set aside for retirement. She loves dogs. She's got a couple of them. She even has a cat. So she loves animals. She's trying to be successful in retirement. She's working with a financial advisor with one of the big name firms that pretty much anybody has heard of if you're familiar with the financial services industry. And in the past year, so throughout 2022, her financial advisor gave her advice, and that advice was just hang in there, don't worry about it. I had the opportunity to review her portfolio. I found out that she's in a bunch of mutual funds with a mutual fund company that most of you would be familiar with. And the advice that she got was, well, hang in there. Well, guess what? So her hang in there advice was she's down over 20%. And her advisor with this firm is charging her a fee. In her case, it's a little bit over 1%. So she's paying over 1% per year to be told, hang in there. And the advisor has made, no change to her portfolio in the past year. A lot happened in 2022. I think there was a lot of reason to believe it probably wasn't going to be a great year. It didn't, it's just not rocket science that we've got problems. We've got inflation issues. We've got government issues. We've got, the economy isn't, there's just, it's not great. And so for somebody to say, I'm going to charge you 1%, and then I'm not going to do anything except tell you to just hang in there, that's one of the biggest issues in our industry and the type of advice that people are getting. And there are far too many people getting that type of advice out there. So Susan's just one example. We sit down with people all over the country every single week that are dealing with exactly the same thing. What we want to do is educate people on all of the investment options that are available. Active management of portfolios. Maybe it's not for everyone, but I have never met anyone who wants to just hang in there all the time. I think usually they're hanging in there because they don't know what the alternatives to hanging in there are. So many advisors out there, when they're telling their clients to hang in there, they always go back to the same story. And I've had this conversation over the years, I don't know how many times, hundreds of times, with individuals that were working with a firm that's just telling them to buy and hold or, again, hang in there. And when things aren't going very well, what they'll do is they'll go back to a chart. And they put this chart in front of a client, and it's usually like a 30-year chart of the S&P. And they'll say, all right, well, I'm telling you to hang in there because if you look at this 30-year chart, this is what the S&P 500 averaged over this 30-year period of time. And if, though, you had missed, pick a number, the 5 highs or the 10 highs over that period of time, if you missed those because you didn't hang in there, your average rate of return would be so much lower. So let's say that I took a 30-year chart of the S&P 500, and let's say the average rate of return was somewhere around 8.5%. And they would say, hey, look, you would have averaged 8.5% over this period of time. But if you had missed the 5 highs or the 10 highs or whatever the number is over that period of time, your average rate of return would be something like 3.5%. So we're just going to stay committed to this financial plan because we want you to get the 8.5%. So even though it feels bad now, it'll feel better later. What they always leave out of that story is, well, let's look at the same 30-year chart. What if you had missed the 5 lows or the 10 lows over the same period of time? What would your average rate of return have actually been? That's not good for their story. That's not a good hang in there story, right? Missing the lows. Well, what we would find is if you had missed the 5 lows or the 10 lows, clearly your average rate of return would be way better than the 8.5% if you had just hung in there. But the reality of investing in markets is nobody has a crystal ball and you can't time markets. But what you can be is more strategic, or we refer to it as just active management in a portfolio. And so what we prefer to look at is what if we look at the same 30-year chart and say, all right, well, what if we did miss the 5 or 10 highs over that period of time? But what if we also missed the 5 or 10 lows over that period of time? What would your average rate of return be? Well, what we would find is if we missed the highs and the lows and we just sort of smooth it out a little bit, your average rate of return would be higher. But more importantly, I think to a lot of people, when they're retired or very close to it, is that your volatility or your risk would be lower. So our goal as you get closer to retirement is not only to get a higher average rate of return, but it's to reduce the amount of volatility in that return so you can have a more predictable outcome, because that predictable outcome is what's going to provide you with income and security in retirement. People ask all the time, hey, you don't have a crystal ball. You can't time markets. You can't do this. You can't do that. All of that, of course, is true. It's factual. We can't time markets. But what we can do is be better educated. We can make better decisions. We can be smarter about our investments moving forward. We don't have to settle for buy and hold. We don't have to settle for hang in there. And then a lot of times when I'm talking to individuals and explaining more in detail how it works, what I'll do is I'll sort of map it out for them, and we'll look at, I'll say 3 concepts. First concept would be, is the market overbought or is it oversold? Overbought just means it's, companies in general are, if you wanted to buy into one of those companies, you're paying more for it than it's really probably worth on paper. Oversold would just mean that if you're buying into it, you're probably getting a pretty good deal. You're buying it for less than it's probably worth on paper. If you look at the market overall, just take an index like the S&P 500. If the S&P 500 is overbought, maybe it's not a great time to start investing more money in it because it's overbought. The probability of it going down is higher than it going up. But if the market is oversold, maybe it's a better time to be investing in stocks or equities or the S&P 500, because if it's oversold, the probability of it going up is higher than it going down. So when it comes to being more active in management of portfolios, certainly we want to look at, is the market overbought or is it oversold? Because that's going to be an indication of where we might like to move. Another indicator that we might look at, and it's a little more technical, would be moving averages. So say the 50-day moving average on the S&P 500 versus the 200-day moving average on the S&P 500. Not everybody gets that far into the weeds when it comes to their portfolios or managing money, but as a firm that manages money, it's something that we're going to keep track of. What I know historically is that if the 50-day moving average moves under the 200-day moving average, historically it's not great. It doesn't mean the stock market crashes every time that happens. But one thing that we can look at historically is if the market has crashed, typically the 50-day moving average would move under the 200-day moving average prior to that happening. So something that we want to look at. Something else we might want to look at, again, not to get too technical, would be conversion diversion. They call it MACD. It's another indicator. But again, if those lines are moving in a particular direction, it's potentially bad for markets. It's a negative indicator. If it's moving in another direction, it's a positive indicator. When you look at all of these things, if any one is happening at a particular time, it doesn't mean head for the hills, buy or sell or do anything. But what we do know historically is if they're moving in the same direction at the same time, historically it's not great. If it's negative, if they're moving in the same direction to the positive side, maybe it's good. If you take that, which is just a very general explanation of how we could be more active in management of a portfolio, and then if you apply it to individuals that are retired or close to it, what we know about people that are retired or close to it is, they want the highest rate of return they can get, but also they're not willing to take a lot of risk to get there. So if we apply that to some measurements in the market, what I also know about people that we work with is they're more willing to give up a portion of gains than they are to take big losses. So let's say that we're actively managing a portfolio. Let's say that the indication is that the market's probably not going to do well. And we go into protection mode for our clients because they want us to protect their money. And let's say that we missed it. Let's say we're wrong. Let's say that we went to really conservative investments and the market went up and our clients missed out on a portion of gains. Well, we would look at that and say, okay, we missed out on a portion of gains. Again, our clients are more willing to do that. But let's say we're right. Let's say that we went ahead and we made a move and we avoided losses in markets, maybe significant losses in the market. If we do that, our clients are going to be very, very appreciative. So there's this balance when it comes to active management of understanding who your client is. Again, people that are looking for the best return they can get. They're just not willing to take a lot of risk. And then also realizing you can't time it, but we can be smarter when it comes to investing, and that's what we're looking to do for our viewers. Thank you for watching. Go to guardingyournestegg.com for your free and objective personal financial plan.